Hey guys, I'm at 2 o'clock. Welcome to today's webinar. It's going to be on tax and accounting in property. Our special guest today is Andrew Potts. Can you hear us okay, Andrew?
Yes, I can. Thank you.
Perfect. Yeah, so I'm going to start by telling you a little bit about the business, where we started, where we are currently, where we want to be. And then Andrew's going to go into the tax and accounting side. There's 4 arms to our business: source property, source development, source capital, and sourced franchise. They all work to make money for the franchise side of our business. A little bit about ourselves. We launched the pilot scheme in January 2017, and we launched the franchise model in September 2017. In August 2018, we became FCA approved. And then in October 2018, we hit 40 franchisees. In February 2019, we launched our largest development to date. This is called Regent's Plaza. It's a £150 million development. We've actually been involved in over £270 million worth of developments as a business now. And then in March 2019, we became registered for ISA and pension funds. Since January 2020, we've raised over £1 million on the peer-to-peer platform every month. And then in April 2020, we had 8 live projects. In March 2021, we hit 150 franchisees. And then in October 2021, we launched our phone app. In November 2021, we acquired a tech company. And then finally, we've just got direct FCA approval. So that's the timeline so far for Source. So as I said, today's webinar is going to be on tax and accounting in property. Andrew's going to talk about that first, and then I'll cover a little bit more about the business a little bit later on. Want to introduce yourself, Andrew?
Yeah, hi everyone. So my name is Andrew Potts. Do you have control of the slides, or do they just keep sliding through?
I do, yeah. So you just let me know when you want me to move on.
Right, okay. So yeah, my name is Andrew Potts. I've been in the industry for over 20 years. We have 2 limited companies now, 2 company practices. We have KP Simpson based in Jarrow, and we have South Shield branch. I'm also quite big into the property market. So I have a separate limited company where we have 4 properties now. I also have a commercial property, which is in my pension in a SIP. I'm also a director of a block management company. We do 3 training courses for Source franchisees each year. Next slide, thanks. So a little bit about the company. So as I say, we're based in Jarrow in South Shields. That's in the northeast of England, just in between, right bang in the middle between Newcastle and Sunderland. We have clients all over England, Scotland, and Wales. We don't have any in Ireland, but we do also have many clients who operate outside of the UK, pretty much all over the world. We have about 1,800 clients, covering all different industries. Part of the team are 20 qualified staff members. We all have different specialities, whether it be income tax, company tax, payroll, VAT, CIS, accounting. And we also work with both wealth managers and corporate financiers. Next slide, please. The things that we're obviously going to be looking at is the tax and accounting in property. Now, it's a very, very broad spectrum, and a lot of the things that I'll be talking about today may not be relevant to you, but some may be as well. When we're talking about property transactions, some of you may have them for a rental investment, so you hold for long-term investment. It may be that you're looking to flip, so properties bought to refurbish and sell. You might develop on land, on greenbelt, so you start from scratch. We may be looking to turn commercial property to develop into residential. You might be looking at HMOs or the furnished holiday lets. This webinar is going to be kind of a broad spectrum on each. It's impossible to be intricate too much within the space of an hour, so we'll try our very best. Next slide, please. So the structures that are available. Oh, yeah. So we could hold them personally as an individual. So you have ownership. They could be in a limited company. You could have them in a partnership with someone else, or you could be in a limited liability partnership, which we'll come on to in a bit as well. Next slide, thanks. So when we're looking at the tax aspects to property as an individual, the things that we're going to look at here is capital gains tax, CGT, or income tax, and also why does it matter? We'll look at hidden tax triggers and using companies. Next slide, please. So the difference in tax is under capital gains tax is a different rate to income tax. Capital gains tax are chargeable on property sales, and the maximum CGT rate at the minute is 28%, and it's taxable at 18% when under the high rate threshold of 50k. That's on residential property. But income tax are profits that are taxable at the revenue rate of tax and NI. National insurance actually isn't applicable to rental income, but it is to trade. And the tax rates for income tax are 20%, 40% over 50k, and then 45% over 150k. And with national insurance on profits over 9.5k, it's at 9%, then 2% over 50k. But these rates are actually increasing to 10.25 and 3.25 from the 1st of April of this year due to the health and social levy, which you'll have seen advertised. Next slide, please. So which one would you prefer? Well, obviously, as I've just mentioned before, you prefer capital gains tax. The HMRC would prefer income tax. What's the difference? Well, CGT is payable on gains on investments, which is such as rental properties. Enhancing a capital asset is still within the scope of CGT, but you are intending to keep the property. If so, then you will be liable to capital gains tax, but if not, it'll be income tax. So income tax will be classified on build to sell. Developing land or property for resale and profit is generally a badge of trade and therefore taxable under income tax in NI. So it's very important that you differentiate between the two, because a trade comes under income tax and investment comes under capital gains tax. Next slide, please. So when is capital gains tax payable on residential property sales? So this applies to disposals. For the new rules after the 6th of April 2020, we actually only have now 30 days to report capital gains tax and to pay capital gains tax on account. You then also have to still include on your tax return as before. So once you make a sale of a property, you have to report that to HMRC. It's within 30 days, pay over what tax you estimate. And then at the end of the financial year, you then do a self-assessment, put the same data on there. And if you then have to pay more tax or pay less tax, you'd either have to make that payment 31st of January or you get a refund. Next slide, please. So there's also the opportunity of using a company. You'll have heard many people say, why aren't you putting your property portfolio into a company? You can do. You can certainly, a limited company can certainly own properties. And like I said at the very start, I do myself. Companies currently pay tax at a rate of 19%. However, from 2023, under the tapered scheme, the maximum tax charge is going to be 25%. So what does that mean? Well, if you've got a few companies that you own and they're all linked in terms of ownership, then profits under 50k will be taxed. So as long as all your profits are under 50k, you'll be taxed at 19%. If your profits go over 250k per year, you'll be paying tax at 25%. And there's a taper in between, and we're still waiting for that taper to be announced yet, and it'll be coming in from the 1st of April 23. So that's the company. The company will pay tax on its profits. However, if you're using the company as the rental income as a personal income as well, then you could have personal tax charges from the income that you take out of the company. Normally, it'll be in the form of income tax or dividend tax. So in essence, you might declare a salary and you'll pay the income tax at appropriate rates, or you'll withdraw dividends at the end of the financial year on after-tax profits. The dividend tax rate currently is up to the high rate threshold, so you get £2,000 free. We then can have 7.5% on the next figures up to 50k, and then anything above that is at 32.5%. But just like the national insurance rates are increasing by that 1.25% health and social levy, as are dividend tax as well. So it's important that you're aware of that fact. So what's the reasons for having a limited company? Now, it can be tax efficient if we're not planning on taking money out, but it can also be tax inefficient if we do want the money out. So as opposed to paying 40% on the rental income, pretty much max unless you're at the 45%, you could be paying anything between 19 and 25% corporation tax, and then 8.75% or even 33.75% in the form of dividend tax, nearly giving half your money away to the tax man. And the tax efficiency of a limited company is then dwindled. However, if we're happy to manipulate tax and not pay and not take any personal income from that, then limited company may well be the quickest way to get additional properties into the portfolio. What else is the benefits of the limited company? Well, it has the personal protection. So if anything should go wrong, it is the limited company that has legal ownership of the liabilities, and it's the limited company that has to deal with them at that point. You guys, as long as you've been protected, as long as you've done everything correct, are protected. However, loan finance is currently a little bit more expensive when loaning via a company. And it tends to be between 1.5% in the mortgages rates that we've seen. That tends to be the case. So you pay more in mortgage interest. However, you will get full tax relief on mortgage interest. Currently, at the minute, if you own properties as an individual, you will only receive 20% interest tax relief on the interest, as opposed to potentially paying 40% on the profitability. So your effective tax rate can increase. Whereas on a limited company, you get the normal tax rate, so you work out your income, less your expenses, profit, and you pay tax at 19% from there. It's also easier to transfer wealth with your spouse, literally just transferring shares as opposed to having to transfer deeds and things like that. So using a limited company can be a good setup. Next slide, please. As we briefly touched on, the tax rates for an individual, we can earn 12,570 tax-free. Next, 37,700 is at 20%. This is on profit or employment income. The next 100,000 at 40%, and then 45% above. And if we're trading, we have to pay national insurance. You'll pay Class 2 national insurance at £158.60, and that's only if your profits are over 7.5k. Then Class 4, you can earn £9,500 profit, and you won't pay any national insurance. Then up to 50k, it's 9%, and then 2 above from there. But again, that's increasing by the additional 1.25%. Limited company and individual. So currently 19%, and as mentioned, it's going to potentially increase to 25 with taper relief. The dividend tax rates, exactly as I just mentioned, £2,000 free. Currently it's 7.5% of the higher rate, then 32.5% of the super tax. And there again, they're increasing by the 1.25%. Next slide, please. So what benefits are capital gains? Well, on residential property, on capital gains, we don't pay tax on the first 12,300 of gain. Basic rate taxpayers will then pay 18% of the remaining gain, and then 28% when we go into the high rate bracket. There are talks, and there have been for quite a while, that the rates will increase, and they've been looking at it, but it hasn't come into force yet, and there's no immediate sign, but it has been talked about and mooted for the last couple of budgets. Next slide, please. Another way of owning could be in the terms of a partnership. So just like individuals, the properties can be owned by numerous people. So you, your wife, your friend, however it's going to be. When we're looking at the taxation, it's taxed in the exact same method as individuals. We would have to work out the profitability. So look at the income, take off the allowed expenses, and the net profit is then split between how many partners are in the partnership, and then that individual partner will pay tax at its appropriate rate. Next slide, please. Something else that you may well be aware of or you may not have heard of could be an LLP, limited liability partnership. So this is a method of ownership that can be explored due to the new taxation rates on both NI, dividend, and corporation tax. So it's got all the hallmarks of a limited company in terms of risk exposure. So what that means is, should anything go wrong, the limited liability partnership would be the one that has to pick up the liabilities, and the partners are only limited by the amount of guarantee that they've put in. So it holds that, that risk level. However, an LLP for a rental business is taxed under exactly the same rules as if you're in a trade. So what that means is you would be paying Class 2 and Class 4 NIC and income tax. So in this instance, for tax purposes, an LLP is possibly not the right way to go, given the fact that you have national insurance to pay. Whereas if it's in your personal names as a partnership, you don't have any national insurance to pay. So an LLP may well be good for a business that is in flipping, which comes under income tax as opposed to capital gains tax. But if you're holding properties for investment, an LLP is not the most tax efficient way to do things. Next slide, please. So When now talking about rental and rental income, we're now going to look at calculate the profits of a rental business. So we take into consideration the rental income, which is all the rents that you've received. We offset the allowable costs. That then gives us the net profit and allows us to calculate your tax liability. Next slide, please. When you're looking at, now you'll have heard the terminology of what can we claim for. And when we use the term claim, no one's ever going to give us any money back. But the claim is against our income to reduce the net profit, to reduce the tax liability. And the terminology of what we can claim is whatever we spend wholly and exclusively in terms of running your rental business. So the obvious expenses include things like letting agent fees, insurance, general repairs to the properties, travel costs to visit the property, and you can claim for mileage of 45 pence per mile for the first 10,000, 25 pence thereafter. Service charges payable to the managing agents, ground rents, utilities for when it empty properties, same as council tax, cleaning fees, accountancy fees for completing your rental accounts, legal fees, stationery, advertising, whatever it is that you spend in terms of generating tenants and looking after the property is allowable for tax purposes. Next slide, please. You notice on the list of expenses that I've just mentioned there is which was omitted is mortgage interest. Now, there's a myth going about that you can no longer use any mortgage interest or loan interest to offset against your rental income when calculating your tax liability. That's not actually strictly true. Next slide, please. There is a caveat though. We can only claim a maximum of 20% tax relief on the mortgage interest, as opposed to we may have to pay 40% income tax on our income. So here's an example. Paul has an employment income of 55k, which means he's a high rate taxpayer. He's also got a rental portfolio of 20k income, 3k allowable costs, which is non-mortgage interest. He then has to pay £12,000 mortgage interest payable. So what's his tax liability? So on this basis, we would calculate the £20,000 income. We would offset the £3,000 expenses, which gives Paul a net profit of 17k. At a tax rate of 40%, he would have to pay 6,800. We can then use the mortgage interest of 12k and we get tax relief at 20%. So 2,400. The two offset together. Paul in this instance would have to pay £4,400 tax on his rental portfolio of 20k. Next slide, please. Capital gains tax when we're looking at the calculation. So again, CGT is only payable when we sell the property that we've held for investment. Not one that we've done up to flip, because that could be held again, as I mentioned, as a badge of trade. This is when we hold them for investment and we're going to get rents. So when calculating the gain, we use the purchase cost and also legal fees on the purchase, as well as any capital improvements that we haven't used in the rental. And hopefully, I think there's another slide, and I'll point to that in a sec. This then forms the base cost of the property, and we offset that against the sale price, less the legal fees or estate agent fees that we've paid on the sale. So we take the sale proceeds, we take off the sales fees and legals, we take off the purchase cost, we take off the legal fees on the purchase, we take off capital improvements. This then gives us our taxable gain, the free pay allowance of 12,300 per year, and the remaining is then taxable at the equivalent rate of 18 or 28%. Next slide, please. When we're calculating, so let's say that's on the rental side of things. Now, when we're looking at a business profit and loss and calculating the profits on a business in terms of a flipping business, we take the sales price, we take off all the associated costs, so the purchases, legal fees, stamp duties, things like that. We take off all the administration costs of running a business, whether that's telephone, staff, motor, anything that's going to be there. And that gives us our net profit. And it's the net profit that is used to calculate either corporation tax and income tax, and then the tax is paid at the relevant rate as mentioned previous. But remember, when we're looking at any offsets in terms of purchases or admin costs, the terminology that has to be used is whatever you spend wholly and exclusively in terms of doing the job role. If it forms dual purpose, it's not going to be allowable for tax purposes. Next slide, please. So what are your compliance requirements with HMRC? Well, if we're a limited company, we have to file what's known as a company tax return, the CT 600. They have to be filed 1 year after the year end of the company's accounting year. Corporation tax on profits, mind, has to be paid 9 months within the year end. Why there's a 3-month extension from filing to being paid, I've got no idea. We also then have to file annual accounts to Companies House, and they have to also be a Companies House 9 months after the year end. As a director shareholder of a limited company, and if you take dividends and we have to pay tax, you then also have to do your self-assessment. If you have personal rental income, you have to also file self-assessment, and they have to be filed by the 31st of January each year. If we were set up as a partnership, the partnership would have to set up a partnership tax return and also the individual partners tax returns, again, by the 31st of January. An LLP, they have to file, as opposed to not filing a company tax return, they have to do a self-assessment for the LLP plus the individual partners by the 31st of January. And then we have to file a set of accounts to Companies House within 9 months of their year end as well. Next slide, please. So what's changing? Well, tax rate, as I've already mentioned previously, tax rates are changing. From the 1st of April 2023, the rates of tax for companies will be increasing. Profits under 50k per year will attract tax at 19%. Profits over 250k will attract tax at over 25%, sorry. And then there'll be a taper system in between the figures. Again, we're still waiting for that. Dividend tax and both national insurance increased by 1.25% from the 1st of April 2022 under the health and social levy. Next slide, please. So, tax efficient tips. If I had £1 for every time I asked this, yes, I would be on a beach somewhere sunbathing, and probably for about 10 more lifetimes as well. When we're looking at tax efficient tips, there aren't many in reality. It's about tax planning and your intention and the relevant tax planning around that. So in terms of what's more beneficial, are we looking to take the money out? Are we looking to just self-invest? What's the cheapest tax rate? Because obviously, if we're looking to self-invest and buy more properties, a limited company may well be the best way. Bearing in mind that we're paying potentially less than half the tax if we're not taking the money out, which allows you to then have more profits in more cash in the business to then go on to your next property and start building a portfolio like that. But everyone's intention will be different, and everyone's tax planning will be different for that very reason. The obvious ones when we're looking at 4 efficient tips, though, are we have to make sure that you're claiming for all the correct deductions possible. Make sure there's nothing missed off. Potentially having properties in joint names with spouse. So in reality, if you're married, because the transfer of assets to husband and wife is tax exempt, you can then look to split the rent, split profits, and wife or husband may be a lower rate taxpayer as opposed to you may be a higher or super higher tax. So there's a way of mitigating that way. Again, like I mentioned before, if we're not looking to receive monies out of property, then a limited company manipulation may well be the best. Another way as well is putting your profits into a pension. So if it's a limited company, the company could set up a pension, or if you put your money into a personal pension, what it does is it extends the basic rate band for tax. So for argument's sake, if you put £20,000 into a personal pension scheme, when we put that 20k in, the government will automatically top up an additional 20% into your pension pot. So that's now a total of 24,000 going into the pension. What then also does is that 24,000 then gets added to the 50,270 basic rate tax amount. So we now have 74,270. And that's the rate. So you would earn £74,270 before we would then pay higher rate tax. So putting money into a pension pot can save you 40% in tax. So that's another option of a tax saving tip. And as I mentioned before, not necessarily what lazy accounting and lazy tax advice is at the minute is put them into a limited company. But as I've mentioned prior, that's potentially not always the best option because it may end up costing you more, if you're already a high rate taxpayer and we want the rent to come to us and to increase our living, then it could end up costing you, well, over 55, 58% in tax, as opposed to paying 40% if they're in your personal name. So it's not always necessarily the right way that a limited company is the best option. And I have this conversation with a lot of prospective clients and current clients who's looking at the best options. But when we, as I mentioned before, we have to look at what your intention are and what the current situation is, because it may well be that limited company is the best, because if we're heavily mortgaged and the interest levels are high and we're a high rate taxpayer, we might be paying a lot more tax via individually as opposed to a limited company, because we can only offset 20% tax relief as opposed to paying 40% income. So everyone's intention is different, and it's very much kind of an individual tax planning method. Next slide, please. Just before we kind of finish off, and then I can hand back to the guys at Sourced, one thing I want to mention is, because what I haven't discussed with you yet, is property improvements and repairs. Going on to what we're looking at between capital gains tax and income tax and the property improvement side of things, as I mentioned, when we're looking at capital gains tax, we work at the calculation on sale fees, sale cost, less sale fees, less purchase cost, less stamp duty, etc., but also less property improvements. Now, there's a differentiation between what falls under capital property improvements and what comes under general repairs. Under general repairs, we can use those general repairs as an offset against your income tax and in the calculation of calculating your profits for income tax, which obviously in our best interest would be ideally the one that we use most costs to put through, because obviously income tax rates could be higher than capital gains tax. However, that isn't for us to decide, sir. So when we're looking at what constitutes capital and what constitutes revenue, any allowable expense on a rental property should be wholly and exclusively incurred as part of a landlord's rental business. It will end up either being classified as a revenue or a capital cost. If the expense is a revenue expense, a landlord will be potentially liable to offset it against any rental income, thereby reducing rental profits and income tax liabilities. Any capital costs will be included in your base cost and will be used to calculate what capital gains tax should be paid. One of the main questions landlords get confused about is whether the expenditure is a repair or an improvement of their rental property. A repair is the revenue expense and can be offset against your rental income. If the work is an improvement, it becomes a capital cost and will only come into play if the landlord sells the rental property. So an example of a repair would be the replacement of a slate roof, like for like. This would be allowable against a landlord's revenue costs. If the costs related to a completely new roof, say as a result of an extension to the property, this would be considered to be an improvement to the property. As such, the costs would then have to be added to a landlord's base costs, and they will be taken into account if and when the landlord disposes of the properties. And they would be incorporated into the calculation of any capital gains. The next extract that I'm about to read is taken from the HMRC website. Maintenance and repair costs. Allowable expenses include the cost of maintenance and repairs to the property, but not capital improvements. A repair restores an asset to its original condition, sometimes by replacing parts of it. Property repairs can include replacing roof tiles blown off by a storm, replacing a broken down boiler, redecoration between tenants to restore the property to its original condition, and replacing a part of the property with the nearest model equivalent if still a repair, if the improvement is incidental to the repair, such as replacing a single glazed window with a double glazed window. So it's important to get the differentiating right where you're looking at tax planning and calculating your tax at the end of the year on your rental income. Now, one of the questions I get asked a lot is, well, okay, what if we change kitchen? What if we change bathroom? What if we change whatever? Now, what I normally suggest is that, because if a bathroom is technically like for like, you replace it with brand new appliances, but they were already there in the first place. our technically gone value is not to be seen to be kind of taking the rise out of HMRC. So if you were maybe spending less than £1,000 on your rental property, then I'd probably be inclined to classify that as rental income. If you were massively modernising the bathroom and spending 2, 3, 4 grand on it, and the equivalent of a kitchen as well, then we'd be looking at probably the basis of that's a capital improvement for tax purposes. So it's important that you take the right advice when calculating your tax on that purpose. That's basically the webinar in terms of rental income and a little bit badge of trade. When we're looking at flipping businesses or property developments, there's a lot more intricacies that you have to take into consideration. There may well be VAT implications, CIS, construction industry scheme tax implications. These things all need to be looked at before you start your project, so you're on the right track moving forward from the outset. It's very important. It's very, well, near enough impossible for me to kind of do this all together on a webinar because everyone's scenario is completely different. But it's important from the outset that you take the right advice and you are put on a path of planning when you start off. That's probably about it for me from the webinar, guys.
Perfect. Yeah, that's great, Andrew. Thank you very much. If you could just stay around for a little bit, we've got a couple of questions that have come in.
Yes.
We'll do that at the end and let a few people ask a couple of questions, and then you can go about your day, mate. That's great. Thank you very much.
No problem.
So I'm just going to jump in, guys. I'm going to talk about a little bit about Source and what we offer as a business, and we can take any questions on that. You can contact me directly if you've got any questions on the franchise side of the business. So we can do up to 100% funding for our franchisees, and the way we do that is we loan a maximum of 70% to the GDV, so the gross development value. So we base on what the property is going to be worth as opposed to the current purchase price, and that's how we can potentially get to the 100% funding for our franchisees. So the system that we use now is a system called Escudo. It's quality leads, bespoke algorithms, and exclusive deals. So our franchisees will get leads that come into the CRM system. It's for them to look into that particular lead in full detail, and then send it over to the support person that will review it and give feedback on that deal. They consist of HMO, commercial conversions, new builds, flips, and we also get planning leads that come into the system as well. As a business now, we've got over 130,000 active investors on our phone app, and they're over 69 countries, and that's increasing by around 300 every week. Our training program, so we actually have over 200 training days per year now. We've implemented a full online training and implementation days in your local area. So we have 73 training days throughout the year that we hold at HQ. One of the ones that has been added is Andrew comes in, does a 2-day course on tax and accountancy. But the rest of the course is you've got your initial induction, sourcing and deal packaging, funding and investors, lease options and HMO, support days north and south, rent-to-rent and serviced accommodation training, commercial conversions and planning, flips and refurbs, and then new build developments. So the running cost and setup with ourselves now, you become part of a national brand and unique network. You get induction training, focus on operation details, JV opportunities with Sourced, a tried and proven business model, access to our peer-to-peer lending platform, exclusive network of over 150 franchisees, deal calculators to assess your opportunities, 1 year bespoke access to the CRM system, communication groups to connect with like-minded professionals, 1 year access to the phone app, 1 year in-person training events, 1 year compliance training, and then sales team to help with investor inquiries. So that's £12,500 plus VAT. So that's for 5 years with ourselves. One thing to add is if you wanted to do a further 5 years at the end, it's £1,000, and that's the legals that it costs us to set you back up for a further 5 years. So you would never pay that 12,500 again. So the license fee, what does that cover? It covers the leads, the dedicated support person that assesses all your opportunities, implementation days in your local area, your one-to-one meetings and tier support, access to the online training 24/7, sourced email, all the legal documents and contracts on the CRM, auction sales, due diligence, tier system, marketing support, and informational resources. So we now charge $245 per month plus VAT. We don't take any royalties anymore in terms of the 5% of net profit for anyone that was looking at it before. We've scrapped that. Okay, so your optional add-ons. So we work with a couple of companies. First one is Loop. So they send direct to vendor letters and we get a 30% discount with them. And then the other company that we work with is Land Insight or Land Tech. We get a 50% reduction on that particular one. We also work with a company called SDL Auctions. Good opportunity for any properties that you're looking at that you can't implement an uplift on strategy. As such, you've got distressed seller. They pay you 2% of the sales price within 7 days of sale or auction. And then finally, the regular activities for a franchisee. So you've got regular training sessions, weekly group sessions and networking, weekly one-to-ones with your support person, weekly webinar hosted by head office at 11 o'clock every Wednesday, capital, weekly group Zooms, meetings and sessions upon request via Canva link, and then decision analysis and feedback from an expert. So that's all for our webinar today, guys. If you've got any questions, do pop them in the Q&A section. Andrew, can you see them or do you want me to read them out to you?
Yeah, I've seen the three there.
Fantastic.
Yeah, so I'll go through one by one. The first question is, do you have to do a self-assessment if you're a director but get no income from your property? No, in previous years, yes, you used to, yes, whether you're a director, whether you received income or not, and you're a director, you'd have to do self-assessment. Not anymore. So the legal requirement now is only if you're receiving dividends or rental income, untaxed income in essence. So if you don't receive untaxed income, no, you don't need to do self-assessment. If you put profit into pension, do you have a limit of 40K per year? Yes, that's right, you do. You may have carry back as well, so you can go back 3 years, I believe, depending on what limits you've used in previous years. But yes, if you've used all your allowances, it's 40K per year you can put in. Do you put the profit into pension? Is the money going to pension after tax? If you do not have tax to pay, do you still get tax relief for the pension contributions? So if there's no tax to pay, yes, it depends on your personal circumstances. As I mentioned with a pension, if you put money from your income into the pension pot, if you put 10 grand in, the government would automatically top up that by an additional 2. So there's 20% going in, so that there's £12,000 going into your pension pot. The £12,000 will extend your basic rate band, personal basic rate band. So if you're a higher rate taxpayer, you'll also receive the additional 20% tax relief from there, and at which point you'd get a refund. If you weren't a high rate taxpayer, the 20% uplift that the government would put in would be the end of it in terms of what you're going to get back. Right, there's another one in the chat. So
have you got that? Yeah, perfect.
So it says, can you say a bit to explain the badge of trade? Yes, okay. So a badge of trade is basically what it is. What are the implications that would classify a trade? Because a trade, remember, falls under income tax as opposed to investment. So a badge of trade will be buying and selling of properties. That will be classified as a trade when we're flipping them, turn them around and then flipping them into, that will be classed basically like a self-employment. That's a badge of trade. Any retailer selling consultancy services, they're going to be badges of trade. Rental income does not form badge of trade because it is an investment income. It also says, yes, my email address is just andrew@kpsimpson.co.uk. There's a .co.uk at the bottom of my franchise. It's source.co is correct. Right. Can you please advise the steps needed to invest in commercial or mixed-use properties through SIPs? No, I'm not a financial advisor. I've done it myself through my own SIP, but through my financial advisor. Let's say I'm not a financial advisor, so I can't advise on what's needed or how it was done. All I did was buy the property through my financial advisor who assisted with us, and then it goes and it's held by the SIP. So no, I'm sorry, I can't really give any more advice for there's not being that financial advisor. Okay, I'm additional.
Andrew, yeah.
Yeah, I've got more. I'm additional rate taxpayer and do not require income now, but would like to build up an additional income for retirement of 5 years. I cannot use a pension. Okay. Well, on your side of things, Harvey, depending on what your intention are, although you don't need the income, it depends on kind of what pension you're going to draw down in your retirement of 5 years. You could you could buy properties in a limited company to minimize the tax that you're paying currently. and use additional profits to then buy the properties. But if you then want to take it out later on down the line, and you've got a pension coming in, depending on how strong your pension is, you'd have to pay in dividends, and you may have corporation tax at a rate of say 19% for argument's sake, but then higher rate in dividend tax, which is going to be 33.75. So that could be 52 and a bit percent that you're paying in future years to draw your money out. Whereas as if you held the properties as an individual, you'd pay 40% tops. So it'll depend on kind of what your pension is moving forward on your drawdown and things. Well, that makes sense. Right. If you do not have tax to pay, do you still get tax relief if you buy a pension? Yes, as I mentioned, the government will automatically top you up by 20%. So they'll put that 20% into your pension pot as additional. So would you have a separate company to hold property, that you want to trade it? Yes. Yes is the answer to that, Jolly. Because of the risk elements attached to them, my advice to you would be, yes, have one company or one set up for rental and one set up for flipping the properties. Harvey, I may take 25% from my pension tax-free and buy some buy-to-let. When I retire, I'll be surviving off harvesting capital gains. Yeah, in that instance, then Harvey, it may well be better off that you don't actually have it as a limited company. You may be better off having it as an individual. Again, it'll depend on what your tax-free allowance is, because there's no benefit having a limited company if you're a basic rate taxpayer. Not at all, because on the rental property side of things, it's going to be 20% only. And even on a limited company, you're looking at 19% capital corporation tax, and 8.75% dividend tax. You're better off holding them as an individual at that point. Luke, what would you recommend as the first steps to sorting out tax when creating an R2SA business? It's looking at the intentions. So again, it's going to be the intentions that how much money are you going to be making? What's your tax implications? It's what your intention, what your expected profitability is, what your other income is going to be, and then that's basically the first thing I'll be looking at. If you pay yourself a dividend, how do you get state pension qualifying year? You don't, because there's no national insurance in. State dividends don't qualify for state pension qualifying. Harvey, can I not repay myself shareholder capital as a way of extracting profit? Yes, you can do. But then obviously when you sell the property, you sell them from there, you don't have any of your director's loan to repay. But you could certainly repay yourself the shareholder capital first without paying yourself dividends. But like I say, once you then sell the properties and you generate profit, you then have to pay all that tax in dividends from there.
Last two questions, Andrew. There's just a couple back on the chat, mate. If you can just answer them, and then we'll wrap it up. And if you've got any more questions, guys, feel free to give Andrew an email.
Yeah, right. Okay. Who have I got that? So, is there an EPC rating related impact on taxation, or will it be something? No, don't think so. Nothing that's come out being mentioned, or nothing that's been mooted or anything. I believe there may be fines coming in, but not under the taxation, and there's certainly no tax benefits for having a good EPC rating. Local authorities might fine you if you've got a bad one, or you might be able to sell the properties or rent the properties, but that's possibly it as far as I've heard. As long as we're a limited company, would you be able to take your initial capital investment up as director's loan without paying? Yes, that is right. So, like I mentioned previously, if you buy a property and you put in, say, 25% is a director's loan for the deposit, you can draw down that on tax-free before we go into profitability to take dividends and what have you. Yes, that is correct. But then when you sell the property, you've already then taken your initial stake out, and then you've got full tax to pay on the dividends from there. Is it possible to claim back all the VAT when purchasing properties that are elected for VAT, even though you will go on to rent the property? No. Are you talking? You'll be talking a commercial opted to tax property, yeah? Is that right, Clayton? Yeah, right, okay. Then in that instance, yes, you would, because what happens is if there's an option to tax on the building on a commercial property, you would then charge VAT on the rent. So when you buy that property, you're technically buying the property as a going concern, which means that you would pay, well, actually you wouldn't pay the VAT, or because if you transfer it into going concern, then you wouldn't pay the VAT, but you have to be VAT registered moving forward. If you do have to pay the VAT, you'll get it back on your first VAT return that you submit, but you would have to charge VAT on the rent that you get paid as well, and then pay the VAT to the taxman at that point. Does that make sense?
Perfect, Andrew. Thank you very much for that. Any more
No problem.
questions, guys? You've got his email address there. It's andrew@kpsimpson.co.uk. If you've got any questions on the franchise side of the business, it's franchise@source.co, so that's correct. Thank you very much for your time, guys, and we'll look forward to speaking to you soon. Thank you, Andrew. Bye-bye.
No problem. Thanks very much.